Well, hello everybody. This again is Sam Lanzafame. Today we're going to be talking about how to calculate ending inventory and cost of goods sold under the perpetual inventory method. We're going to be analyzing three different techniques that exist. One is called FIFO, first in, first out. The second one is called LIFO, last in, first out. And the third one we're going to look at is the weighted average cost method. So without further ado, let's get right into it. You'll notice over to the left, I have a data box. I've repeated this data box a couple of other times here. So if you just kind of glance down as I'm kind of scrolling down, you'll notice that I just repeated the data. This way we don't have to scroll up and down so much during the presentation. So the first thing we're going to do is we're going to enter in the opening balance. So I've just created a little fictitious example here just to help us go through this process. We're starting off with some inventory. So on January 12th, we've got 100 units at $10 a piece. And the value of that inventory to start us off with is $1,000. Now, I highly recommend when you are doing this technique, uh, whether it's FIFO, LIFO, or weighted average, when you're using perpetual and you're using this grid, I would highly recommend that you color coordinate your transactions. In other words, for every date, create a color or alternate colors. It'll just help you to read this a lot clearer. If by the time you get done with this, it can look a little confusing. So if you color coordinate it, it won't look confusing at all. So highly recommend that you use colors, and you can just kind of follow along with what I'm doing. It doesn't matter what colors you use. Okay, the next thing is we've purchased some more units. So on June 8th, under the purchase column, we're going to put 200 units at $11 a piece. And as you can see, the balance in this account, well, the balance of the purchase in dollars, 2,200. Here's where it becomes extremely important. You have to record your ending balances in chronological order. So you have to show them in the way they arrived. So we had 100 at $10. So we need to repeat that information. So I'm just copying what I had before. And now I have just acquired 200 more. And these units that I just bought cost me 11. So what I need to do now is figure out what's my total in my inventory. I can just go 1,000 plus 2,200 to give me 3,200, or I can do it a little bit more detailed, just in case you might be fearful of making a mistake. This is another way to double check to know, hey, I'm supposed to end up with 3,200, and we do in fact end up with 3,200. What I'm going to do is I'm going to color code this new date in a different color. So I'll go with green here. So basically what I've just shown you is that on January 12th, we had 100 units at $10 for $1,000. On June 8th, the inventory balance now consists of those same 100 at 10, but now an additional 200 at 11. So I have to constantly show on every single date exactly what I have in inventory. You might be thinking, well, how stupid, why did I bother writing the 100 at 10 when I already had the 100 at 10? Again, pretend, you can't see January 12th. Let me just hide this just for a quick second, just so you can see what I'm saying. So imagine I put a piece of paper over all the dates but June 8th. I need to be able to see on June 8th exactly what's on inventory or what's in inventory. I don't want to have to rely on going back to previous months or previous dates to know exactly what's in there. So on June 8th, this is the snapshot of what my inventory consists of. So you want to remember to always bring your information down. Okay, so in terms of FIFO or LIFO, we actually don't have any change in answer to this point. You don't see FIFO or LIFO rear its ugly head until you sell. And now we're about to sell. So you've noticed it says here August 11th, and we are going to sell 250 of them. Well, if I look at my green ending balances, I've got 110, I've got 211. I want to sell the first 250 because the first ones in are the first ones out. Out means sale, sold. So I want to sell the first 150. I've got 300 there, and I want to sell, the first 250. So I have to take the 100 at $10. And then I'm going to take another 150 from the $11 group. So again, according to the yellow data box to the left, I sold 250. I had 300 available. I have to sell the first 250. So let's see what that total comes out to. 100 times the 10 plus 150 times the 11, and that gives me 2,650. So what do I have left in inventory? Well, the 100 at 10, those $10 ones are gone. I only have 50 left of the 11. So how did I get 50? I took 200 minus the 150 that I removed, so that gives me 50 left. The 50 are from the $11 group, and now my balance after the sale is 550. So I've got $550 worth of inventory left over, and it's made up of 50 units at $11 a piece. Let me just pick a different color for that one. Okay, so I'll just alter my data so that you can kind of look at this later and say, oh yeah, the green one was with the green one, blue was with the blue, that sort of thing. Okay, didn't change to green. There we go. All right, so now it's September 1st, and we want to buy some more. So September 1st, we bought 200 units, and these cost us $12 a piece. So we got a little bit of inflation going on here. You know, the inventory we had at the beginning originally cost us $10. Then we bought some of the same stuff, and then it was costing us 11. Now the same stuff we're buying is costing us 12. So we definitely have some inflation happening here. But in our new inventory, I look at what I had most recently, 50 at 11. So I want to copy that. And then what I want to do is add in my new stuff, 200 at 12. So now my inventory total, 50 times 11 plus 200 times 12. And my new balance is $29.50. So let's give that a color. Just change it up. Go with that. So now I have an inventory 50 at 11, 200 at 12. It's now time for November 9th. And on November 9th, it says we sold 150. So which 150 did I sell? I've got 50 at 11. I've got 200 at 12. If we're doing FIFO, what are you thinking? If you're thinking first one's in or the first one's out, means I got to take the 50 at 11 and then I got to take 100 at 12, you are right. So let's do that. So we'll take the 50 at 11 and then we'll take another 100 at $12. So that's going to give us cost of goods sold for this particular transaction. of $1,750. In terms of my ending balance, I no longer have the $11 group. I just have 100 of the $12 group. So how did I get 100? 200 minus the 100 I got rid of. And these are recorded at 12 bucks a piece. And that's going to give me 100 times $12. It's going to give me $1,200. And that's our final answer. So under FIFO, we have determined that the value of the ending inventory is 1,200 bucks. Okay. In terms of cost of goods sold, I can also calculate that. So let's say it would be the 2,650 plus the 1,750, and that's $4,400. So that's stuff that's under cost of goods sold. When I sell, like if I go back to August, the blue, when I sell those 250, I better sell them for more than $2,650, or I'm going to lose money. For the most recent one, I sold 150 of them. Those 150 cost me 11 and 12 bucks a piece. I better sell them for a lot more than 11 and 12, or I'm going to lose money. So between the two, that stuff that I sold cost me 4,400. I better sell them for more than that. Okay, so that is FIFO. So now let's do the exact same problem, but this time we're going to do it under LIFO. LIFO stands for last in, first out. So let's go ahead and begin this process again. So on January 12th, we have an opening balance of 110. And that's going to be $1,000. And let me color code that in yellow. The next thing, June 8th, we bought 200 at $11. And these cost us $2,200 to acquire. So now my balance, if you remember from up top, I have to show not only what I acquired, but what I had. I think I had put this in green. So now I've got the 100 at 10, and now I have 200 at 11. So just like up top, when we did FIFO, I'm going to go 100 times 10 plus the 200 times the 11, and I get 3,200. You could be saying to yourself, why don't you just add the 1,000 in yellow to the 2,200 in green? That also would have gotten you 3,200. Absolutely, you could have done that. But what if you made a mistake in here? You want to make sure that you go through this math under the ending balance column and just kind of use this the first way that you were thinking as more like a check. But you don't want to make any errors in here, so you want to make sure this also tallies 3,200. Okay, so now it's time to sell. And let's put this in blue like I did last time. Now, so far we have the exact same answer after June 8th as we did up above. Notice 100 at 10, 200 at 11 for 3,200. And we got the same thing. So now you can see them both actually on the same screen there. 100 at 10, 200 at 11, 100 at 10, 200 at 11. So when you just purchase stuff, your FIFO and LIFO look the same. It's not until you sell that you start seeing some differentiation. So let's now sell under LIFO. LIFO says the last ones that came in are the first ones out. So on August 11th, if we're selling 250, which 250 are we selling? So if you're going, oh, it's got to be the 200 at 11, you're right. And then we're going to grab 50 from the $10 group. So our balance, our cost of goods sold balance, is 200 times 11 plus this 50 times the $10, and we get $2,700. Just a quick glance up top. When we did FIFO, look what it cost. The cost was $2,650. Notice that the cost is higher under LIFO. Interesting. And this is a predictable phenomenon that I'll explain later. So what do we put in our inventory? Well, we no longer have 200 at 11, and we got rid of 50 of the $10 group, which means we've got 50 left of the $10 group. So let me just do that math real quick, and you can see our inventory is now down to $500. So now it's time to go buy some more. It's now September 1st, and we're going to buy 200 at 12. And 200 times 12, as we can see from the data box, is 2,400. Let me color code this one just like the other ones. I think I used this one last time. Doesn't really matter. Okay, so in our inventory, we have the old 50 at 10, and now we just acquired 200 more at 12. So let's do the math here. 50 times 10 plus 200 times 12. And now our balance in inventory is 2,900. So we've got 250 units, 50 of them are at 10, 200 are at 12. So now we're going to sell. It's now November 9th. And on November 9th, let me color code this one. And let's see, we'll use this one here, this color green. Okay, so on November 9th, we sold 150. Which 150 are we selling? Last ones in are the first ones out. So refer back to the last date, and the last ones that came in were the $12 ones. So we're going to get rid of 150 of those. So 150 at 12 is what those are costing us to sell. So our inventory consists of the old 50 at 10 are still there. And since we got rid of 150 of the $12 group, we still have 50 of the 12. So now our inventory, 50 times 10, and 50 times 12. And now our inventory balance is 1,100. So notice, just look up above, you'll notice that when we had 100 left over at 12, we said our inventory value was $1,200. Now we're saying our inventory value is 1,100, and the 1,100 is made up of 50 of 10 and 50 at 12. Remember when I did the math up here and came up with a total of 4,400? Well, if I were to add those up under the LIFO, 2,700 plus the 1,800, you get 4,500. So notice we have more cost of goods sold under the LIFO than we did under the FIFO. Let me put this in a box just to make it stand out here. Okay, and then notice our answer for the ending inventory, 1,200 versus 1,100. So when your inventory is low, your cost of goods sold is higher. Okay. Alrighty, let's now switch over to weighted average. Under weighted average, we don't care about which ones came in first or second. Basically, everything takes place on one row for each date. Okay, so I'll just kind of color coordinate initially here. Oh, let me just do this here. Just to show you right up front what this is going to look like in terms of how many rows it's going to take up. We're going to go blue. This one will be blue. And make this one that boring kind of color. And then this last one, we'll make it green. Make it a dark green. And the first row is good old yellow. Okay, so unlike the previous two, where we had to take up more than one row sometimes to complete the inventory, and sometimes it could take up 2, 3, 4, depends on how the numbers work. The most we had in the previous two was only 2 lines worth, but it could have been 3 or 4. So I don't want you to think it's just, 1 or 2. But when you do weighted average, it's always just 1. Okay, so January 12th, and the ending balance 100 at $10. So let me just copy those in here. And as we can see, again, we have for the third time $1,000 worth of inventory to start the process. Now we're on June 8th. And on June 8th, we bought 200 at 11. And let's do that math, 200 times 11. And for the third straight time, we have 2,200. But now here's where weighted average differs from the previous two. Again, in this technique, we don't care which ones came in first, which ones are leaving first, it's irrelevant. We're doing an averaging type of format here. So what you're going to do is you're going to take your old units of 100 and you're going to add your new units of 200. So now we have a total of 300 units. Skip the unit cost column and now go to the final dollars. I had $1,000 worth of inventory. I'm adding another $2,200 worth of inventory. I now have $3,200 worth of inventory. So to figure out my unit cost, I have to divide 3,200 divided by 300, and that's going to give me an average price of about $10.67. I'm guessing that's rounded. That probably is 10.6s, but Excel is showing to the second decimal place or to the hundred spot or to the cents. Okay, so notice how our unit cost has increased. It was $10. Now each unit has an average cost of $10.67. Every time you purchase, this unit cost will change. So now we are selling. It's August 11th, and we are selling 250. How much are these 250 costing us? It's costing us this 1067. Don't just type 10.67 because 10.67 is rounded. So literally click on the cell and Excel is going to use the original unrounded answer in the multiplication. So 250 multiplied by the 1067, and that's going to give us $2,667.67, rounded to the nearest penny. So what do we have left in inventory? we only have 50 left. So 300 minus the 250 we sold, we got 50 left. And let me bring down this 1067. So 50 units multiplied by that 1067, and we've got $533.33 worth of inventory left. Okay. Fix my date. There we go. I keep putting odd. There we go. It's very odd. Okay, next one, September 1st. And on September 1st, we acquired 200 more units. And at $12, so 200 times the 12, 2,400. Now let's add it to our inventory. Take the old units of 50, add the new units of 200. So now we're up to 250. Take our old dollars and add our new dollars. And we're up to 2933.33. Let's now do the division. 2933.33 divided by 250 units, and now our average inventory unit cost is approximately $11.73. Notice how the value of the inventory is increasing because it's costing us more to acquire the inventory. So again, we're in an inflationary scenario here. So not unusual for this to be happening. November 9th, we get to sell, and we're going to sell 150. We're selling them at that 11.73 figure. And when we do this multiplication, 150 multiplied by the 11.73, 1760. So what do we have left in inventory? We should have 100 left. That's what we had left every other time. And that's the case. Bring down that 1173, and your final inventory balance ends up being 1173.33. So notice our final answer here. If we compare it to LIFO, we had 1100, and when we compare it to FIFO, we had 1200. So 1200 was the high inventory, 1100 was the low inventory, and look at weighted average, somewhere in the middle, 1173. Very typical that it's somewhere between FIFO and LIFO. In terms of the cost of goods sold total, if we add our two cost of goods sold amounts, this answer should be between the two cost of goods sold amounts that we saw for FIFO and LIFO. So let's take a look at it. We got 4426.67. And let me just put that in bold. Put this one in bold as well. Not only in the box, but bolded up. So 4426, we had 4500 for LIFO, and we had 4400 for FIFO. So again, 44 was the low, 45 was the high, 4426 somewhere in between the two. And that's how you do perpetual under FIFO, LIFO, and weighted average. In the next demonstration that I do, I will be doing FIFO, LIFO, weighted average in what is called the periodic method. All right, you guys have a great day, and hopefully you are enjoying these little teaching scenarios on different accounting techniques and principles. All right, take it easy. Bye-bye. All right, well, hello everybody. Welcome to another edition of Accounting Principles. Today we're going to talk about how to calculate ending inventory and cost of goods sold under 4 different techniques. One's called FIFO, first in, first out. Second one is called LIFO, last in, first out. Then we have weighted average, and then specific identification. Of these 4, the one that is the most accurate is the specific identification. But ironically, that is the one that is least used in practice. The reason being is that most companies are utilizing one of these techniques to better aid them in reducing their income taxes. So if you can find a technique out of these four that will increase the amount of expense or write-off that a company takes, oftentimes the company will take that route. Alternatively, some companies will forego that tax advantage and will use one of these techniques based on what other companies are using in the industry. I don't think that's as popular as saving money. Therefore, I think the ones that are used most often are the ones that will reduce your tax impact. So, given the scenario that is presented in the data box, you will notice that prices are going up $10, $11, $12. And because of this, we are in a period of inflation. When you are in an inflationary scenario, meaning rising prices, what's going to be to your advantage is to use the LIFO method. So as we look at all of our results, as we compute each of these techniques, we will notice that FIFO and LIFO will be the high and the low. And weighted average will be somewhere in between. Specific identification can be anywhere on that timeline. Could be the best, could be the worst, could be in the middle. There's no specific spot where SID falls when comparing the four to each other. All we know is that all out of the four, SID is the most accurate, but it's seldomly used. So let's go ahead and see what these answers end up looking like. I can tell you right now that LIFO will be the best when it comes for taxes. So expect to see LIFO with the lowest inventory and the highest cost of goods sold. Let's see if that pans out. So if you look to the data box, you'll notice that we have beginning inventory on January 12th. We've made a purchase on June 8th. We've made a purchase on September 1st. Total of 500 units available for sale. That GAFs that you see there is goods available for sale. The 5,600 represents the cost of goods available for sale. So we've got the cost of those goods. You will notice that the ending inventory is made up of 100 units. So if we had 500 available to sell and we have 100 left, that means we must have sold 400. So our job is twofold. Number one, let's put a value on that ending inventory first. Secondly, let's calculate the cost of goods sold. Okay? So if you notice over here to the right, I have under FIFO, when calculating ending inventory, pull your numbers from the top of the data and work your way, pull your numbers from the bottom of the data and work your way up. Okay, so that's what we want to try and do. So what may be jumping out at you initially is, boy, that seems backwards. Why am I pulling from the end? I thought first in were the first ones out. That is true, but we're after what's left. So instead of looking at the ones that went out first, we're trying to figure out the ones that are left over. So the first ones in are the first ones out. That's true, but we're after the ones that are still left, the ones that we haven't sold yet. So our job is to put a value on the 100. And as the instructions say, when calculating ending inventory under FIFO, pull your numbers from the bottom of the data and then work your way up. So we need to account for 100 units. So if there's 100 left, they must have come from the September 1st purchase. If you can see that we had 200 there, and we want to take those first. So to do this calculation, we're going to simply, from the September 1st purchase, we're going to take the 100 units at the $12 and multiply these two numbers with each other, and we will get $1,200. That is the value of the ending inventory. We just calculated it. That's it. That's all there was to it. So to calculate our cost of goods sold, we have this little format that we want to use. We'll take our cost of goods available for sale, which is the 5,600, and we now want to subtract out the ending inventory result that we just computed a minute ago, 1,200. And let me just identify that. And then what we want to do is subtract the ending inventory from the cost of goods available for sale, and we will end up with our cost of goods sold results. And not too challenging of a math question, 5,600 less the 1,200, and our cost of goods sold result is 4,400. That's it. That's all there was to calculating FIFO. So the key was figuring out the ending inventory first and then subtracting that result from the cost of goods available for sale, and that gives us our cost of goods sold. So now let's go to LIFO. LIFO is going to be exactly the opposite. It says under LIFO, when calculating ending inventory, pull your numbers from the top of the data and work your way down. So again, I want to acknowledge that there's 100 units in inventory. So let's go ahead and figure this one out. I'm going to start at the top and work my way down. So I want the first 100 that I see from the top. Let's put this in a different color here. Let's go green. Let me highlight this in green as well. Okay, so now these units are coming from the January 12th purchase, and we're taking all 100 at the $10, and you can see that's going to give us $1,000. Now remember, I predicted that if we are in a scenario of rising prices, oops, did the math wrong, pardon me, we will see that the LIFO result is going to be larger than the FIFO result when it comes to cost of goods sold. Remember, the whole point of utilizing these techniques is to find the one that's going to give us the largest write-off. The more expense you show on your financial statement, the less tax you pay. So companies are striving for, the little loopholes, the little tax advantages that, they're allowed to take advantage of. So let me just copy some of this information here so that I don't have to repeat it, and then we'll change the numbers around. Okay, in fact, it already did it for me. So cost of goods available for sale, 5,600. I go to subtract out my ending inventory of 1,000, and notice that now my cost of goods sold, as predicted, is larger than what we saw under FIFO. So if you were running a company and you had an opportunity to write off 4,600 as opposed to 4,400, you would opt to go with the 4,600 because this way you'd end up paying less tax. So the more cost of goods sold, remember, cost of goods sold is an expense account. The more expenses you have, you hate them, but you love them. They're like a double-edged sword. You hate to have expenses, but the more you have, the less tax you pay. So anything you write off enables you to end up paying less tax. So companies are always striving for write-offs. Unfortunately, there are companies out there that will create fictitious expenses or write-offs. And this is not this. This is a legal way to figure out what's the best way to save on paying taxes. You have 4 techniques that are given to you by the accounting gods and the government gods. So hopefully you utilize the one that you want. Now, there's only one little stipulation though, and that stipulation is that this is crazy, but you're only allowed to switch techniques once in the company's existence. So in other words, the government and the accounting gods give you one mulligan. So let's say for the last 5 years, you've been using FIFO and you're like, man, I want to switch. You can, but once you switch, you can no longer switch back. So that's the only negative associated with what technique the accountant may end up utilizing. Okay, but they are allowed to switch once to kind of like fix a previous mistake or poor decision, or maybe the industry has changed and prices go in a different direction. So again, if prices are going up, you're in inflation scenario, you want to be using LIFO for the best tax result. If prices are going down, like in the tech industry, you want to be using FIFO. FIFO will give you the best tax advantage when prices are decreasing. Okay, so now it's time to do weighted average. Weighted average, as you can see from my instructions, under weighted average, take your cost of goods available for sale, which is the 5,600, and divide it by the goods available for sale. This will give you like an average unit cost. And then you're going to multiply your result by the ending inventory in units. So we don't care about dates for this one. We're simply going to take the 5,600 and you're going to divide it by the 500. So let me try to make a little fraction here. And hopefully that looks like a fraction. Let me center these so it looks even better. More like a fraction. Okay, so we got dollars on top. We got units on the bottom. All right, so let me just make a little equal. Oops, not there. Let me just make a little equal sign to show that I'm about to do or show you some math. And when I do this, center this. Watch what I do here. I'm going to take $5,600 and I'm going to divide it by 500 units, and I end up with $11.20 per unit. Okay. So once I have that $11.20 per unit, notice the prices were 10, 11, 12. So the answer had to be somewhere between 10 and 12. You're then going to multiply this result by how many units you had in ending inventory. And the results of doing this is your answer. So $11.20 multiplied by 100, and we end up with 11.20. That will represent your ending inventory in dollars. Okay, so that's your answer. So now, my keyboard always sticks a little bit here with this new computer that I have. Doesn't do what I want it to do. There we go. So now let's take a look at our results of computing ending inventory with cost of goods available for sale to come up with the cost of goods sold result. So again, we have 5,600 ending inventory. We just calculated as 1120. And now we want to do that subtraction. And we end up with 4,480. Decrease the decimal here. Okay. So again, this result somewhere in between your FIFO answer and your LIFO answer. Remember, under FIFO, we got 4,400. Under LIFO, we got 4,600. And this one's almost to 5,500. Finally, the last technique, which is the one that's most accurate but seldomly used. I gave you some information right from the get-go. Let me just reiterate that. And of those 100 units that we have in inventory, we are pretending that we know exactly where they came from. And in the instructions here, let me just copy this down here. You'll see, let's assume the ending inventory consisted of 50 units from January and 50 units from June. So you would simply take your information. I'm just going to copy this and then change the numbers. Put it right here. And let me change this to 50. And then change this to 50. So of the 100 units that are in ending inventory, 50 of them came from January, and the other 50 came from June. So you would be privy to this information if you were counting the inventory. So if we then do the math, add the 500 and add the 550, we have 1,050. So let's again do our little calculation here. Technically, as I said before, this one is the most accurate of the three. Ending inventory is now 1,050, and we end up with 4,550 as our final answer. Again, notice that LIFO is still the best answer. So under conditions of rising prices, LIFO will always give you the number one answer in terms of the highest amount of cost of goods sold. The highest cost of goods sold will give you the lowest ending inventory value. So on the company's balance sheet, the company would show whatever the value for ending inventory is for their merchandise inventory. And then on their income statement, they would have a write-off of whatever the cost of goods sold amount happens to be. The more cost of goods sold, the lower your gross profit. The lower your gross profit, the lower your taxable income. And then you take your tax away, which obviously if you show a lower taxable income, you're going to pay less tax. So of these four techniques, the one that makes you pay the least amount of taxes is your LIFO solution. Again, because we had rising prices, 10, 11, 12, prices went up, therefore LIFO is going to be the best. Okay, that's it. So I hope you guys have a great day, and hope you come back to see the next presentation about the actual impact on the financial statement. So what I was just describing orally, I will actually visually show you how these results impact the financial statements. And that's it. All right, you guys take it easy and have a good day. Bye-bye. All right, well, hello everybody. Good to have you again here. This is Professor Lanzafame one more time. And today we're going to talk about the effects of making the decision on using FIFO, weighted average, or LIFO. So this is a continuation of my last video. And over at the top right, or actually in the middle top, I have the results of the last video. When we were doing FIFO, we came up with ending inventory of 1,200 and cost of goods sold of 4,400. And I have the detail below on how that was attained. We first figured out the ending inventory, and then once we knew that, we subtracted it from the cost of goods available for sale and got cost of goods sold. And I have the other results down below from the last video. So what I did was I just kind of summarized them at the top, middle, and we have the results 4,400, 4,480, 4,600 under FIFO, weighted average, and LIFO. Now, if you recall in the last video, we were experiencing rising prices. And whenever you have inflationary scenarios, LIFO will end up being the best for tax purposes. If you take a look at what I have over on the right, I have in period of rising prices, LIFO will be the best choice for tax purposes because it reports the lowest amount of inventory, but the highest amount of cost of goods sold. And remember that COGS is an expense account. The more expense or write-off a company takes, the less tax the company pays. FIFO would end up being the best if you were in a deflationary situation. And just a little international note, LIFO is not recognized under international accounting standards. In fact, under IFRS, which we were supposed to join in 2014, then was delayed to 2017, but it sounds like there's another delay that is occurring. one of the things that's, in my opinion, that's stopping the US from completely converting to this international way of doing accounting is that international accounting does not recognize LIFO. This will dramatically impact most of the US companies, particularly if those companies use LIFO. So we're talking about most likely millions and millions of dollars that will now have to be taxed because they will have to either switch back to FIFO or switch to weighted average because they will not be able to use LIFO any longer if we convert to international reporting standards. So stay tuned for that. But in the meantime, let's go through our example. This is a short video, and I want to show you the effects of the decision making associated with choosing FIFO, weighted average, or LIFO. And if you notice at the top left of the screen, I've already created kind of like a little mini income statement for the three scenarios. So what I'd like to do is let's just pretend that this company had sales of $20,000, and I'm going to create that $20,000 for each situation. If I can type correctly. There we go. And let me just drag that across. So no matter what scenario is chosen, the decision for FIFO, weighted average, and LIFO, that comes into impact ending inventory, which then impacts COGS. So your sales are not affected by the decision. So let's see the result of this subtraction. If we do it under FIFO, we get 15,600. And let me just drag this across one more time. And you can see we've got 15,520 for weighted average and 15,400 for LIFO. Pay close attention to the LIFO. Notice that has the smaller gross profit. And that was predicted because of the higher write-off of cost of goods sold. The company's going to have lower gross profit. Ultimately, they'll pay less in taxes. Let's also figure out if we take out operating expenses from the mix. Again, operating expenses are not affected by FIFO, LIFO, or weighted average. So notice that under FIFO, they have a net income of 12,600 before tax. Under weighted average, they have a net income of 12,520. And under LIFO, they have a net income before tax of 12,400. So notice the taxable income is lower under LIFO. And look at the tax. If you were using FIFO, you'd pay $5,040 in taxes. If you were under weighted average, you'd pay $5,008. And if you were paying LIFO, you'd pay less than $5,000. So if you had the choice come tax time to pay either $5,040, $5,008, or $4,960, something tells me you'd probably prefer to pay the least amount. I know I would. So ultimately, after tax, we're going to subtract out these expenses, and you will see that even though FIFO reports the highest amount of net income after tax, the people that use FIFO ended up paying the most amount of taxes. So kind of crazy how that worked. So FIFO, net income after tax versus weighted average versus LIFO. But the key to this video today was to show you that depending on which technique you choose, that's going to affect how much tax you pay. And under LIFO, because the prices were going up, we ended up paying less in taxes than if we were using FIFO. Okay, that's it. Nice short video, and next time we're together, I'm going to do some journal entries comparing perpetual to periodic. Have a great day, everybody. Bye-bye.